Welcome to the next episode of Small Business Legal Tips. I'm attorney Mark Bross of Bross Law LLC. I'm a practicing business attorney with over 15 years of experience helping Massachusetts business owners buy, sell, and protect their businesses. Today we're going to talk about how to get your business ready for a sale. Many business owners who have been operating their business for years are thinking about selling their businesses and retiring. And good for them. However, most have never gone through this process before and aren't ready for it. And I'm not talking about being emotionally ready to retire, but I'm talking about being legally and financially prepared for the scrutiny that's coming. During due diligence, a buyer is going to dig through every corner of your company, including your financial statements, corporate records, contracts, employees, and anything else in connection with the business. And if the buyer finds problems, the buyer will either walk away from the deal or come back with a much lower price. No seller wants that to happen. However, many potential problems can be fixed before you put your business up for sale so that they never become an issue. In this video, I'm going to walk you through 5 steps to take before you put your business up for sale so that you can find and fix potential problems that can cause a major headache during the sale. By the end of this video, you'll know exactly what steps to take in order to find potential problems, and more importantly, you'll know when to take them in order to fix them before the sale. And if you find this tip helpful, please like the video, subscribe to the channel, and ring the bell in order to get more helpful legal tips like this one. It really helps the channel grow and lets me know that you want to receive more practical advice like this. So let's get to it. The single biggest mistake I see when business owners are selling their business is lack of planning. Often, a business owner will get a letter of intent from an interested party, which they accept right away because they think it's a great deal. After you accept the letter of intent, this will lead right into the due diligence process where the buyer starts requesting all sorts of information about your company, which you need to provide as soon as you can. This leads to a mad scramble on your part to pull together all the documents and all the information that's being requested and gives you no chance to fix any problems that you might discover. If there are problems, this last-minute rush can cause the business owner a significant amount of money, and in worst cases, it can kill the deal entirely. So, the first step you want to take is to start preparing for the sale 2 to 3 years before you actually plan to sell your business and put it on the market. While this might sound like a long time to prepare, it gives you the luxury of time to clean up your operations before you put your business up for sale and any buyer actually sees it. If a buyer finds a problem during due diligence, you're stuck fixing it under the extreme pressure of the buyer looking at it or letting the buyer use the flaw to drive down the price. However, if you find the same problem 2 years out, you have time to fix it quietly and clean it up before it ever becomes an issue for a potential buyer. To start this process correctly, you need to assemble the right team, and there are 3 specific people you want in your corner before you do anything else. First, you need a business attorney who understands Massachusetts law and specifically handles business transactions for business owners. Your attorney's job at this early stage is to review your corporate records, your contracts, and your employment practices to see if there are any problems that might cause issues during a potential sale. You want your attorney to be the one who discovers these problems because any problems that are discovered are covered by attorney-client privilege, and your attorney can start taking steps to actively fix the problems before the sale. Most buyers are going to hire their own attorneys to help them evaluate the business, so if there are any problems with your business, the buyer's attorney is going to discover them. It's far better to know about these problems in advance so that if it's possible, you can fix them before you put your business up for sale. And if you can't fix them, at least you know they're going to be potential issues and prepare to negotiate regarding them. The second person you need as part of your team is a CPA. So you should tell your CPA as soon as possible that you are planning to sell your business and ask them what should be done to prepare the business for sale. If you don't have a CPA, hire one now with extensive experience in selling businesses. A CPA is going to be invaluable because they can help you with all sorts of things about getting your business ready for sale. They can make sure that all your returns are filed on time. They can clean up any of your financial statements and other records and just generally make sure that everything is financially set before the business is actually put up for sale. The other thing that a CPA can help with is help you evaluate what's the best way to actually sell your business. The way a sale is structured can matter for your bottom line and whether the deal is set up as an asset sale or a stock sale can have major tax implications for you. Your CPA is the person who's going to help you understand what you can actually walk away with after the government takes its share, and that final number can look very different depending on the structure of the deal. The third person you want to bring on as part of your team is a business broker or a mergers and acquisition advisor, also known as an M&A advisor. This business professional helps you figure out what your business is actually worth in the current market, how to position it to receive the best price, and how to find buyers who are actually qualified to buy your business. The broker will ultimately take a commission for the sale, but a good broker is invaluable in getting your business ready for sale and in finding qualified buyers. Ideally, these three professionals should all work together in order to make sure that your business sale goes smoothly and that you get the best price for your business. So when you're hiring any one of them, make sure and ask them their policy about communicating with other members of your business team when selling your business. Usually it's not a problem, but you want to make sure and double check with each professional to make sure that they don't have an issue with working with other members of your deal team. Once your team is in place, the next step to tackle is your financial records. Your financial records are going to be one of the first things that any potential buyer wants to see, and if your books are a mess, it can sink your deal or dramatically lower your price. Here's the core issue. When you're selling your business, buyers are going to want to see at least 2 to 3 years of clean, professionally prepared financial statements. This is going to include a balance sheet, an income statement, and possibly a statement of cash flow. Buyers are going to want to understand exactly what your business earns, not what you think it earns, but what the numbers actually show on paper. If your records are disorganized or incomplete, a buyer simply can't justify paying top dollar for your business. There's too much uncertainty and they're not sure what they're getting. One of the most common problems I see is personal expenses mixed in with business expenses. Maybe you run your cell phone expenses, your car, your internet services, or even a vacation home through your business. This is fairly common with small business owners, but it creates all sorts of problems when a buyer is trying to figure out what your business is actually worth and how much profit your business actually generates. Your CPA and possibly your bookkeeper need to go back through your books and records to cleanly separate out your personal items from your business expenses so that your business profit and loss statement tells a clear, accurate story for your business. The other thing your CPA should try and do is reconcile all of your accounts and make sure that your financial statements are consistent from year to year. Buyers and their accountants are looking for consistent patterns, and inconsistencies can raise potential red flags or at least potential questions. If your revenue jumps dramatically in one year and declines in the next, and there's no clear explanation about why that happens, a buyer is going to ask hard questions, and if you can't answer them clearly, that creates doubt on the part of the buyer. The bottom line here is simple. Clean and clear financial books and records tell a buyer that there is nothing to hide in your business or how it makes its money. And that impression has a direct impact on what the buyer is willing to pay for your business. The next step you want to take to prepare your business for a potential sale is to make sure you are in good standing with the Commonwealth of Massachusetts. And there are at least 2 different ways to be in good standing. Tax good standing with the Massachusetts Department of Revenue, which is also called the DOR, and organizational good standing with the Secretary of the Commonwealth of Massachusetts, which I also call its Corporations Division. These are entirely separate requirements, and you need to be in good standing with both the DOR and the Division of Corporations before a business sale actually closes. Let's start with tax good standing because it involves the most paperwork. Before your sale can cross the finish line, you have to obtain a tax clearance certificate from the Massachusetts DOR. In plain English, this just means the DOR confirms your business has no outstanding tax liability, which include things like unpaid income taxes, meals taxes, or employee withholding. Tax good standing really matters for a potential buyer because under Massachusetts General Law, Chapter 62C, Section 52, a buyer can actually be held legally responsible for a seller's unpaid taxes if that clearance isn't obtained before the closing date. That means your tax debt becomes the buyer's problem, and any buyer's attorney who knows what they're doing will demand that certificate. If you can't produce that piece of paper, the entire deal stops dead in its tracks until you can. The problem here is that this can take a while. You have to file a formal request with the DOR, then they review your entire account history, and if they find even one small issue like a late return or a tiny balance discrepancy from a couple of years ago, you won't be in good standing and you'll have to fix it before they'll issue you a certificate of good standing. You definitely don't want to be chasing down tax records from several years ago the week before you're supposed to close, so please start this process as early as possible to make sure that you're in good standing with the Massachusetts DOR. The second type of good standing is organizational good standing with the Corporations Division of the Secretary of Commonwealth of Massachusetts. This is completely different from being in good standing with respect to your taxes, and even if you are in good standing with respect to your taxes, you may not be in good standing with the Corporations Division. Being in organizational good standing means that your LLC or corporation is current with the Corporations Division. To stay compliant, you must have filed all your annual reports on time, kept your registered information accurate, and maintained a current business address on file with the Corporations Division. While this sounds like a basic administrative task that all businesses should be on top of, I am constantly surprised at how many business owners haven't filed an annual report in years or have inaccurate information listed. These small oversights create massive headaches and can cause real delays when you're trying to close a deal. As part of any closing, a seller who's organized as a corporation or an LLC is going to be required to provide a certificate of good standing from the Massachusetts Division of Corporations. And if there are any missing annual reports or other inaccurate information, you're not going to be in good standing with the Corporations Division, and you'll be forced to scramble to try and fix it while also trying to manage the sale. It's much better to handle this right now, or have your attorney handle this right now while you're not in the middle of a potential business sale and have all sorts of other things to do. So go to the Secretary of the Commonwealth's Corporations Division website right now and look up the records for your corporation or your LLC. I'll put a link to the website below. You simply need to go to the website, put in the name of your corporation or LLC, and view all the records. Check to make sure that the information is accurate and that you have filed an annual report for each and every year that you've been in business. If there are some years that are missing, file them now. Otherwise, you won't be able to obtain a certificate of good standing when it's needed to close the sale. The next step to take now is to find out whether you have any potential employee issues with respect to payment of wages or other matters. As I've discussed in other videos, Massachusetts has some of the strictest wage and hour laws in the entire country, and if your payroll practices aren't 100% clean, that exposure is going to surface during due diligence and could cause all sorts of problems. The reason this is such a big deal during a sale is because of the penalties involved. As I've discussed in earlier videos, violations of the Massachusetts Wage Act carry mandatory triple damages plus the cost of the employee's attorney's fees. So if you paid your employees improperly and you accidentally underpaid an employee by $5,000, your actual legal exposure isn't $5,000, it's $15,000 plus whatever it costs the employee to sue you or even just send you a letter. There's almost no legitimate defense to a Wage Act violation, and the fees are automatic. So during due diligence, a buyer's attorney is going to look at your wage practices, and if they see any risks, they may use it as a reason to restructure the deal, slash your asking price, or walk away. No buyer is going to want to take on potential Wage Act violations, so if you have any issues, this will absolutely guarantee that it will be an asset sale rather than a stock sale. The second part of the employee puzzle is worker classification. As I mentioned in an earlier video, Massachusetts uses the ABC test under General Law, Chapter 149, Section 148B, to decide if a worker is truly an independent contractor. The Massachusetts standard is much tougher than the federal rules, and to keep someone as a 1099 contractor, you have to prove that the worker meets all three prongs of the ABC test. And as I discussed in the earlier video, that's very hard to meet, and I'll put a link to that video below. In my experience, it's almost impossible to meet all three prongs of the ABC test, and most small businesses who use independent contractors instead of employees are misclassifying their workers and violating the Massachusetts Wage Act. To give you a real-world example, imagine you own a website design and SEO consulting agency where you use three regular independent contractors. These supposed independent contractors work set hours for your business, they only work for your firm, and they do the exact same type of creative work that your business sells to clients. Even if you've been paying them as 1099 contractors for years and they like being independent contractors, they should be employees under Massachusetts law. This creates a massive trail of unpaid payroll taxes and potential Wage Act claims that a buyer's attorney is going to flag as a major potential liability. At the very least, they're going to recognize that you've been improperly shifting some of your business expenses onto the backs of your supposed independent contractors. When a buyer sees this kind of mess, they really only have two options. First, they can walk away from the deal entirely because they don't want to deal with the potential liability or deal with the hassle of trying to clean up your mess. Second, they can seek to reduce the purchase price they're willing to pay for your business because they realize that you've been underreporting your business expenses and that your business is not worth as much as you think it is. Either scenario is a mess for the seller. So how do you protect yourself? Easy. Before you put your business on the market, you, or more likely your attorney, should perform a thorough internal audit of your employee payroll and wage practices. Look at every single person you pay, whether they are an employee or an independent contractor, and verify that your W-2 employees are being paid correctly and that anyone being classified as a 1099 independent contractor actually passes the Massachusetts ABC test. If you find any problems during your audit, start fixing them now. You can reclassify your workers and clean up your payroll and financial records before a buyer even looks at your books or an employee files a complaint. This is exactly why I tell business owners who are looking to sell their business to start the preparation process 2 to 3 years before they're actually looking to sell. The next step to take in connection with preparing your business for a sale is to minimize the risks of successor liability for any potential buyer and understand what needs to be done to assign your business contracts to another party. Successor liability is a legal concept where a buyer of your business can be held responsible for your old debts and legal obligations, even if the buyer had no idea those debts existed when they signed the purchase agreement. This is a serious issue for both parties, and it is one of the main reasons why the way your deal is structured matters so much. In Massachusetts, most business sales are set up as asset sales, which means the buyer is only picking up specific parts of your business like equipment, customer lists, and intellectual property. This is different from a stock sale or membership interest sale, where the buyer is buying all of the equity in the company and assumes ownership of the assets and liabilities of the company. Most buyers will insist on an asset sale because they don't want most of your liabilities except for contractual liabilities, which we'll talk about in a moment. However, one important thing to understand is that even with an asset sale, there are certain exceptions where liabilities can follow the business no matter how the deal is structured. This includes tax liabilities, certain employment claims, environmental liabilities, and some others. So speak with your attorney about these potential risks to make sure that any associated liability is minimized for any potential buyer before putting the business up for sale, and your attorney can include whatever language they want in the purchase agreement to protect you after the closing. This will maximize the potential value you can receive for your business and also give comfort to any potential buyer that they're being protected. In addition to successor liability risks, you also have to look at contractual liabilities, which are often assumed by a buyer because they are valuable and essential parts of your business operations. However, just because you have a great lease or a key vendor contract does not mean that those contracts automatically transfer to a new business owner. It all depends on the specific language of the agreement. Many commercial contracts and almost every commercial lease contains a clause that prohibits assignment without the other party's consent, which is often called an anti-assignment clause or just an assignment clause. This means that your business cannot transfer the contract to somebody else without getting written permission from the other party to the contract. If you sell your business without getting these consents, the contract might automatically terminate and the buyer will not be able to rely on the contract or receive its benefits. Let's look at a real-world example of how this can destroy a deal. Imagine you own a restaurant with 3 years left on a lease that has a great below-market rent and a perfect location. That lease is a huge part of why your business is valuable, but if it has an anti-assignment clause, you're going to need the landlord's permission to hand it over to a potential buyer. Usually, this is not a big deal. But if you wait until the last moment to ask the landlord to consent and ask them to move as quickly as possible, this may anger the landlord and give them all the leverage in the world and reason to refuse to assign the contract. They can demand a huge rent increase, ask the buyer for a personal guarantee, or simply drag their feet long enough to kill the deal entirely. The fix for this is straightforward, but it requires you to start early. At least a year before you plan to sell, you should sit down and make a full inventory of every key contract your business relies on to function and operate. This list should include your leases, your vendor agreements, your client contracts, software licenses, and any restrictive covenants like non-competes or NDAs with employees or other businesses. For every single one of these, have your attorney check the assignment clause to see if a transfer is even allowed. If the contract says assignment is not permitted, you won't be able to move it as part of the sale, and if consent is required, you need to strategize on the best time to have that conversation with the other party to the agreement. Here's a pro tip. Be very careful about when and how you approach a landlord or a major vendor about assigning a contract. You need to balance your reputation, your relationship with the other party, the remaining time on the contract, whether there's any renewal option of the contract, versus the reality of whether these contracts can actually be transferred to a potential buyer. If you handle the assignment process the wrong way or at the wrong time, you could jeopardize your relationship with a key partner before the sale is even a certainty, or whether you're even certain that you actually want to sell your business. So let's do a quick recap of the 5 steps we discussed today. First, you need to assemble the right team: a business attorney, a CPA, and a business broker, and to start the process 2 to 3 years before you plan to actually sell your business. Second, you need to get your financial records in order. Buyers want to see at least 2 to 3 years of clean, professionally prepared financial statements, and messy books will cost you on the price. Third, you need to get your tax and organizational good standing squared away with both the Massachusetts Department of Revenue and the Secretary of the Commonwealth's office. Fourth, you need to audit your wage and employment practices before a buyer does, because a Massachusetts Wage Act violation carries substantial damages and can kill a deal real fast. And fifth, you need to take a hard look at your essential contracts to understand which ones require the other party's consent, such as a landlord or a key vendor, before they can be transferred to a new owner. Now, if you're really serious about selling your business, I want you to pick at least one of these areas and take a single action on it this week. You can start assembling your team, look at your company's records with the Mass Division of Corporations, or sit down and start the contract inventory list. Taking these small steps now is the best way to prevent massive, stressful, and expensive problems in the future after you actually find a buyer. I hope you found these tips helpful. If you found it helpful, please like the video and share it with another Massachusetts business owner who might be thinking about selling their business. And make sure to subscribe to the channel for more practical small business legal tips. Thank you so much for watching, and I'll see you in the next episode of Small Business Legal Tips.